Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you're tuning in from. The Hot Sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's Hot Sheet, I will discuss the latest CPI report from this morning, relief for renters, and home price declines. Today is Tuesday, June 13th, 2023. I am Byron Lazine, and the Hot Sheet starts now. Welcome back to the Hot Sheet. Glad to have you here today on this Tuesday morning where we got an 8:30 a.m. Eastern Time CPI report, which will certainly impact the Fed's decision. They're meeting today and tomorrow. Tomorrow, we're going to get the final say on what they're going to do here in this June FOMC meeting. Right now, just based off of Fed Fund Futures projection, they have a 95% chance that the Fed will pause the federal interest rate tomorrow. Some of that does have to do with the report that just came out this morning. So let's dig into it. Inflation rose at 4% for the annual rate in May, which is the lowest in 2 years. Now, next month's July CPI report is going to be interesting because next month is the year-over-year report from the peak of inflation. Okay, so June of last year of 2022, we peaked at 9% inflation. So next month's report, which would be for June, today's report was for May, of course, would reflect year over year. So psychologically, just looking at where we've been from peak to 12 months later, it'll be an interesting report to digest. But let's digest this one, okay? And I'm just going off of straight from the source, the news release from the Bureau of Labor Statistics. All of the charts that I'm going to use on this show, as well as the source links, will be available for you in the daily download. There's one link below so you can get the daily download. The consumer price index for all urban consumers rose 0.1% in May on a seasonally adjusted basis. That met expectations. Generally speaking, this report met expectations, maybe a little bit, warmer in some spots than Wall Street wanted, but overall meeting expectations, which is a good sign after increasing 0.4% in April. So the expectation was we would just increase 0.1%, experiencing some disinflation from April to May. We did meet that. It's obviously down from the 0.4% in April. The U.S. Bureau of Labor Statistics also reported that over the last 12 months, all items index increased 4% before seasonal adjusted. So that's that 4% inflation number that we're talking about here. That's the number that the Fed, of course, is trying to get down to 2%. So here you can see the blue line would be all items for the CPI. You can see in June where we had the 9%. Obviously, May of last year, we were pretty close to 9%. We're up over 8%, and now we're sitting at 4%. So you can see that the trend has been since May of last year, outside of the tick up in June to 9, which was our peak. From June to today, we've been on a downward trend, this disinflationary trend for CPI. When you go all items less food and energy, it's a little more flat, 6% last year in May. Now we are just over 5% on that number. This chart looks great because we met expectations in May at 0.1%. We also saw 0.1% in March. We saw it in December. But for the 1 month percent change in CPI, this was expectations, and this is a really good number for where we want to end up, showing signs that while taking longer than anybody wants, we are experiencing some disinflation. All right, so the index for shelter, of course, once again, the index for shelter was the largest contributor to the monthly all items increase, followed by an increase in the index for used cars and trucks. So those are the two hottest sectors of inflation. It's shelter, it's rent, and it's also used cars and used trucks. The food index increased 0.2% in May after being unchanged in the previous 2 months. So not much there on food, which is good because that certainly impacts the everyday American. But yet it did increase a little bit, 0.2%. Again, it was unchanged the previous 2 months. The index for food at home rose 0.1% over the month, while the index for food away from home rose 0.5%. The energy index declined 3.6% in May as the major energy component indexes fell. So that's good news there. All items index increased 4% for the month ending in May. This was the smallest 12-month increase in the period ending March 2021. All items less food and energy index rose 5.3% over the last 12 months. The energy index decreased 11.7% for the 12 months ending in May, and the food index increased 6.7% over the last year when you're looking at year over year. All right. Let's take a deeper look onto shelter here. Got a couple of charts pulled up for that, or tables rather. And here we go. All right. So if you look at this, when we're talking about the food, this is that number here in May, 0.2% after being unchanged in March and April, but still, much healthier than where we were November, December, January, February, where you're seeing food go up 0.6, 0.4, 0.5, 0.4. So food has started to level out. If you just look at the hot topic was eggs, a few months ago. If you look at that chart, it has plummeted and come back down to earth. So overall, getting more stable on food. Again, here's that energy drop in May, 0.36 after having a 0.6 increase in April. All items less energy and food, 0.4 there. And so now we come down to shelter. This is the one that is concerning. Despite the fact that, listen, they're using lagging data. We've talked about it on the stream a whole bunch. The shelter data that the Fed is using for the CPI survey, it's ridiculous. It was born in the 1980s. They literally call homeowners at their home. They ask them what they think their house would rent for. It's just ludicrous that this is what we're using when we have other information at our fingertips. I'm going to dig into some of that information that's at our fingertips. There's a story in the Wall Street Journal today about rent prices that we're going to go over. But let's just go based off of what this report says. This report says that shelter in May went up to 0.6, and that's an increase. We don't want to see these numbers here across the board. We want to see those going down. All right. So November we had a 0.6 increase. December we had a 0.8. January, we had a 0.7. February, we had a 0.8. Then in March and in April, we started to see a downward trend, which was a good sign. We had 0.6 in March. We had 0.4 in April. So today, looking at a 0.4 or a 0.3 would have been a positive for shelter, but we got a 0.6. Unadjusted 12 months ending May 2023, you've got an 8% increase for shelter. Okay, so not good the way the Fed looks at shelter. Again, we're going to look at it from a couple different scenarios here in just a little bit, but overall not great. Shelter, of course, always makes up the largest percent of inflation. And today, again, according to this report, not coming in exactly where we want it to. Shelter, this is that number there, that 34.564. That's how much shelter makes up of this CPI report. Okay, so this is basically making up over a third of inflation would be shelter. Again, these numbers on the right are the ones I just went over. This was last month and this is this month. So you're seeing an increase month over month on shelter. Rent of primary residence ticked down. Okay, so 0.6 last month to 0.5 this month. Lodging away from home went up after being negative 3% last month. In May, we had 1.8 on an increase. Housing at school, excluding board, came down a little bit. That's not really a big deal. Doesn't make up a large majority. As you can see, this number over here, it makes up a really small percentage of that third. It's 0.159. Other lodging away from home, including hotels and motels, went up. We had a negative 3.4 last month, and we're at 2.1. Owners equivalent of rent residences has been flat the last 4 months at 0.5%. That makes up 25.432. So basically makes up a quarter of inflation. So that number's been flat. The overall shelter number, again, is the one that went up zero point 0.2 from April to May. Okay, so that's directly out of uh, the Labor Bureau report that came out this morning at 8:30 sharp. I have those below for you in the daily download. You can grab those. You can grab those other inflation charts. You can also grab the whole entire PDF that I have down below. It's a 38-page report, and you can go through the whole thing. You know, what food or used cars. It was interesting in here. Transportation. I'm sorry, cars. New cars. New cars went up quite a bit. Where the used cars went up quite a bit, over 4%. Where new cars are starting to come down. Okay, so let me see if I can find that here. If you just look, if you're watching right now, not listening, this is what this thing looks like. So there's just so many different, um, numbers. It breaks down every single item you can basically think of. Airline fares came down, so that was a good one. Airline fares continued to come down. That was a good. Here it is. Used cars and trucks went up 4.4%. 4.4% for used cars and trucks, while new vehicles came down 0.1% after being down 0.2%. So new vehicles is showing a trend of coming down. That's these numbers here for the last 2 months, while used cars 4.4 increase the last 2 months individually is not showing any signs of slowing down. So interesting enough there. There's some resistance on new vehicles. Those prices have kind of topped out, but used cars and used trucks have not. Apparel is up 0.3. That's flat with the last 3 months. We had, I think, one of the biggest increases was financial services, so tax consultants, financial services. Again, food was a good number. Energy was a good number. Other household equipment and furnishings came down. So, other household equipment and furnishings. I'm sorry. This number here, the past 2 months has come down 0.9% in April and 0.6% negative in May. Okay, so less people going out and spending on the home. We reported that in Home Depot's earnings. They were, I was like, I was kind of bullish on people doing renovations, buying more stuff for the home with less transactions. We're not seeing that. So people are holding back a little bit on spending inside the home. Tools, hardware, outdoor equipment, and supplies was also down. Outdoor equipment and supplies leading into spring being down 0.8%. Another good signal there for how the Fed's going to be looking at this report, breaking it down. Obviously, that's a small component of inflation, but I'm just pointing out some of the, some of these little items. Furniture and bedding down 0.7% after being down 0.5% last month. Window and floor color coverings and linens actually went up 0.2 after being down 1.7. Okay, so these are all little items. It all adds up to the grand total here. And the grand total, again, is 4% on inflation. We're trying to fight it down to 2%. That's the Fed's target. Next month is the year-over-year report from peak of inflation at 9%. So we'll get the year-over-year look at CPI when that comes out in July. And again, right now, the Fed Fund Futures is pricing in a 95% chance of a pause tomorrow for the federal interest rate. This report here that we just went over, today's CPI report, does not, it doesn't guarantee what they're going to do in July. Okay, we got a 95% chance of a pause tomorrow, meaning the Fed pausing the federal interest rate, the overnight rate. July is still up in the air, whether they're going to hike. We're obviously going to have a lot of data that comes out between now and then, whether they're going to hike or continue to pause. This report certainly doesn't suggest that it should be a guarantee that they're going to pause again in July. It was overall basically meeting expectations, but still shelter going up, not good. the way they're going to look at that. It makes up a third of the inflation report. And we have some conflicting reports on shelter, on rent. Today in the Wall Street Journal, just released this morning, renters are about to get the upper hand. Okay, now this is something I've been talking about. We referenced last week. If you go back, I think it was on Friday. I believe it was on Friday. We talked about the Redfin rental tracker, which the Redfin rental tracker shows, of course, that asking rents fall 2% in the West. They've risen in the Northeast and the Midwest, but that nationwide rents have declined 1% from a year earlier in May, which was the largest drop in 2020. That's according to Redfin. We talked about that. We talked about Barry Sternlight, who says inflation is going to drop hard once this lagging data on rental and shelter catches up with these outdated CPI reports like the one we just went through. Okay, so we've got a lot of data out there, rents.com, apartments.com, all suggesting that rents are coming down. Now the Wall Street Journal is saying that renters are about to get this upper hand. New lease rents are poised to fall on an annual basis for only the second time since the 2008 financial crisis. Okay, apartment rent growth is declining fast, shifting the rental market to the tenant's favor for the first time in years. Obviously, when you look at a home purchase, are sellers in favor or buyers in favor? You need 6 months of inventory. People have been way off of that on home purchases, right? We're between 2 and 3 months in almost every market in America, meaning it's a seller's market. What this report here is saying that for only the second time since 2008, you're going to have a renter's market. The average of 6 national rental price measures from rental listing and property data companies shows new lease asking rents rose just under 2% over the 12 months ending in May. That is down from double-digit increases of a year ago and represents the largest deceleration over any year in recent history, according to data from CoStar Group and rental software company RealPage. Of course, CoStar would have a significant amount of data in this discussion. An annual decline would offer relief for millions of renters who have had to contend with rents that rose 25% nationally over less than 2 years. With housing costs at the biggest component of the CPI, the CPI is the report that we just went over, a decline in rents would also help ease inflation. Yes, we've been waiting for this to actually get pulled out of that report. This report here that we just went over didn't do that. It actually went up. A year-long drop in rent would be a potential problem for many investors who took out large loans to buy buildings where they thought they would be able to keep raising rents. They are facing a softer market, falling property values, and interest rates that have roughly doubled from early last year. We've also reported here on the stream in the last couple of weeks that there's significant inventory in quarter 3 and quarter 4 hitting the market. There was a whole bunch of, I put it into the daily download last week. Let me see if I can find that one. It wasn't on Friday. Here, I'll find it in just a second. Here it is. So this is the markets that are getting a supply expansion when it comes to rental apartments. New apartment supply delivering in urban core submarkets from 2023 to 2024. Nashville is delivering over 10,000 units. That's a supply expansion of 36%. Do we not think that much rental inventory is going to have an impact on prices and vacancy rates, right? As tenants' leases come up and they have an opportunity to go to something new, these are going to be brand new units, maybe with a deal, maybe 3 months off, maybe some of these developers got to make deals to fill up the vacancies. Is that not going to impact prices overall? Salt Lake City's supply of expansion rate is going to go up 30%, 6,400 units coming on. This is just quarter 3, quarter 4, quarter 1 here. Phoenix, Charlotte are on the list. Philadelphia, Raleigh on the list. Okay, Tampa would be the lowest on this list, and they still have a supply expansion rate of 10.4%, 2,500 new homes. So that's the other part that a reason why renters in the future, especially in some of these major markets where they've been building apartments, where renters are going to have an easier time, a better advantage than they've had the last couple of years. One of the rent measures from real estate brokerage, Redfin already shows asking rents turning negative with a decline of 0.6% in May. Talked about this on Friday, and that's the rental tracker that I just referenced here. Compared with the same month last year, the data includes both apartments and single-family rental homes. A decline in asking rent over a 12-month period has only happened one other time since the 2008 crisis, according to some data sources, when the rental market briefly dipped in 2020 because of the outbreak of ending a decade-long streak of rent increases. Okay, so the U.S. rental market slowing down after this unprecedented run. In some markets, such as Miami and Riverside, California, monthly rents are up 35% or more over the past 3 years. Let me know what it's up in your market if you've got data on that. But the high prices started to weaken demand from renters in the second half of 2022, many of whom were pushed to their financial limits by these higher rents. Some are moving back in with parents, taking on roommates, or relocating to cheaper cities. There's a report, I think it's from, let me find it here. There's a report from Redfin, I believe. Another report from Redfin. Where is it? It's essentially so you had moves from people, going out of town at 17%, and that's dropped now down to 6%. Out of town moves falling. This is a Redfin report. Out of town moves have fallen 6%, it is, from a year ago, compared with 17% drop for in-town moves. So you just have less people deciding to make these moves right now because of the price resistance that they're experiencing in the market. A historic number of new apartments under construction that I just referenced is also forcing more competition among landlords. A historic number of new apartments. Okay, we talk about all this lack of inventory, and that's true on the resale side. That's true on affordable single-family home purchases or affordable condo home purchases for buyers who want to be a homeowner, who want that advantage of being 44 times more wealthy than the renter over their lifetime. That inventory is not, it's just so low. It's at historic lows right now, the last couple of years. But we have a historic number of new apartments under construction. Okay, so when you hear things like, they want to turn this into a renter nation. Yeah, because the municipalities, the counties, the states have made it so easy for landlords to go and just developers rather, to go and build these apartments. Okay, and they haven't done enough to work with developers to say, hey, no, let's build single family for sale units so that we can better the lives of the people in our community, turn them into real estate owners, into home owners, and let's go out and put that product onto the market. But they think they're doing good by getting more inventory in the form of apartments. These apartments end up being, a really high price. And I just don't think it's a good thing to have a historic number of new apartments. It's going to overall push people into rentals as these rent prices come down, as opposed to pushing people into the position to be a homeowner. You will see a trend that goes that way over the next 5 years with this historic number of inventory coming onto the market. There's certainly a correction taking place, as Rob Warnock, a researcher at rental website Apartment List reported rents rising under 1 percentage point for the year ending in May. Okay, so there you go. That's what Wall Street Journal's reporting, that renters are about to have the upper hand. But there are 3 real estate REITs that, just as of today, this is according to John Burns Consulting, all 3 publicly traded San Francisco REITs just reported, single family REITs just reported a 7% rent increase for all to see. Think inflation is getting under control, asked John Burns from John Burns Consulting. Single family rents are the largest component of the CPI. That was that 20, basically a quarter of the CPI, which uses very old methodology with very lagging data. And I agree, John Burns, it is absolutely insane what they're using there. But single family REIT summary that they just released 52 minutes ago, John Burns Consulting shows us a different story than what I've been talking about, and certainly what we want to believe for the future of inflation. Okay. April 2023, same home performance statistics reported publicly by the single family rental REITs point to continued strong demand in second quarter of 2023. Okay, so new lease rent growth, according to INVH, 7.5%, renewal rent growth, 7.2%, blended rent growth, 7.3%, occupancy is 98%. Okay. Whew. New lease rent growth for AMH, 9.4%, renewal rent growth, 6.2%, blended rent growth, 7.1%, occupancy, 97.1%, TCN, new lease rent growth, 11.9%, renewal rent growth, 6.5%, blended rent growth, 7.6%. Obviously, this is single family rentals. As these apartments come on, the overall rent number can continue to go down. This is just single families, but these numbers are hot. So this shows you that there's still incredible demand for single family rentals. That, this suggests, according to John Burns Consulting, that they're still going up. I'm still looking at, hey, Barry Sternlight, CEO of Starwood Capital, he's modeling rent prices coming down. Apartments.com is doing the same. Redfin is doing the same. Obviously, Wall Street Journal collected 6 different, rental analysis, and they're saying rents are coming down, inventory is coming on, rents are going to have the upper hand. But I do want to take into consideration all reports, and this John Burns report does suggest that single family REITs point to continued demand being very strong into the second quarter of 2023, which obviously we're going to be finishing up at the end of this month. Okay, so that's just the other side of the coin. Obviously, we're going to show everything here on the hot sheet, all sides, all stories, so we have all the data. And again, you can go back to that Redfin report and you can actually get some localized data for your market. We talked about it on Friday, where the Northeast was up 5%, but the West was down 2% on rent. So everything's going to be different for your local market. And I'd love to know from you what your local market looks like. Now, shifting over to home prices, there was a report this morning from Capital Economics. The housing market is so detached from fundamentals that a leading research firm, Capital Economics, predicts the pause in home price declines is about to prove temporary. Okay, so back in July, economists at Capital Economics put out a report arguing that U.S. housing market demand had finally bottomed following last year's mortgage rate-induced pullback. Not long after that report was published, housing metrics began to show a bounce back up as 2023 spring market came to life. Okay, so of course, Case-Shiller, the gold standard in home prices, has reported that after falling for 7 straight months, national home prices rose in February and in March. The expectation is that when Case-Shiller's next report comes out, April's going to show a rise, just as Zillow has shown April on the rise, as Black Knight has shown April on the rise. So we think Case-Shiller's going to come out and validate those other early reports. Early May signals are that home prices are going up. So we should see not only April, but when May data comes out later, we should see 4, maybe even 5 as we get into June, months of increases after seeing 7 straight months of national home price decreases going all the way through January per Case-Shiller, of course. But this report, Capital Economics, believes that we will experience some more home price declines. Okay, so in that January report, the UK research firm predicted that U.S. home prices had not reached the bottom. Peak to trough, Capital Economics expects U.S. home prices to fall 8%. Okay, fast forward to today, where Capital Economics put out a new report titled Pause in Home Price Declines to Prove Temporary. Pause in home price declines. So declines have paused because Case-Shiller and others reported that month over month home prices are going back up, that this is just temporary, what we're experiencing right now in the spring market. The report argues that following the resilient 2023 spring housing market, home prices in the second half of the year will revert back into correction mode. Now, and this is being reported in Fortune from Lance Lambert. It's also something I've talked about here. Okay. I believe that when we get to the end of quarter three and into quarter four, especially where we are sitting with the 30-year fixed mortgage rate, that we are likely to see some of those seasonal months where you see month over month home price declines, not a cliff, not some catastrophic loss of home value for any home owner, but a month over month decline, certainly in quarter four, before we experience a 2024 with potentially a lower 30-year fixed and a market that continues to increase into 2025. If I'm a betting man, I'm just going off of that based on where things sit, the lack of affordable inventory um, out there, and I think there's going to be even potentially less by the end of the year inventory, which is just going to keep people saying, you know what, I'm not going to go out there and do anything. You're going to have some sellers in the higher price points that aren't able to find as many buyers as they are sitting a little more cautiously. The 7-month run of home price declines recently ground to a halt, with Case-Shiller index showing these increases. This was partly driven from a temporary boost to start the year. We've already seen, the mortgage applications continue to go down. So, there are buyers with the seasonality starting to drop out of the market or just kind of getting burnt out. But rates have obviously since uh, returned close to the double decade highs that were set last October. This is causing that demand to fall. Okay. So, not everybody is on the home price increase train. Certainly, I could see a couple months where we recorrect again before the end of the year, and not everybody's on the train that I'm on. That rents are dropping and dropping throughout the rest of the year. Of course, John Burns' report would be against that. So. Let's see where we're at on the 10-year now after the CPI report today. We have a 10-year that is unfortunately going up. It was down before we started the stream, and we're up 3.776. The big watch on the 10-year is going to happen tomorrow after Jerome Powell's speech. We'll obviously cover that in its entirety Thursday morning. Yesterday's 30-year fix reacted to an increase in the 10-year and went up to 6.94. Hopefully we can stay away from that psychological 7 number. We've been dancing just under it now for the last week and a half. What you want to do is dance with myself and Tom Toole and 2 members from our teams tomorrow on the cold call event. We are going to be doing a cold call event here on the channel going live at 4 p.m. We're going to be calling past clients. Now, we've done expired listings and we've done a bunch of others. We've done these events have been fantastic. By the way, there's a link down below so you can sign up and get notified for this. Make sure you subscribe to the channel, of course, but that'll be 4 o'clock tomorrow, where we're calling past clients and using the terminology and the scripting that you're going to want to call your past clients. Okay. So tomorrow, 4 o'clock, cold calls for past clients. We're going to break it all down. And then we're going to have an after party at 5 o'clock. That's over on BAMX, where we go through Q&A from the cold calls, where we debrief that cold call event in its entirety. And you only get access to that if you're a member of BAMX. So make sure that you sign up below using the code HOTSHEET to become a member of BAMX. That's 15% off the annual subscription. BAMX is filled with courses right now, a private community where we're sharing things that you can't find anywhere else on the internet. Of course, you get massive discounts to all of our creator courses, and the annual subscription with the code HOTSHEET is less than a cup of coffee a month. So jump in there. You'll be able to have access tomorrow to the after party for the cold call event, which will start around 5 o'clock. We'll shift over there, answer questions, and debrief the entire event and all of the calls. So that's tomorrow at 4 o'clock. Make sure you don't miss it. Today here on the channel at 2 p.m., we've got a real word pod, which I'm super excited for. And until tomorrow morning, I'll see you in the comments, and toodaloo.